How we doing, everybody?
Good afternoon.
Good afternoon. Raul Hernandez here with the Grimaldo Group. I'm a local realtor out here in the west side of the valley, and I've been doing real estate for about 3 years and a half or so. It goes so fast. This is a really, really exciting time to be in real estate, I feel. I've been able to help many, many families. And one of the persons that have helped me to do that along the way is our magic man here, Chris Verdin. He's a super great lender out here in the valley, and I'm gonna pass it off to him so he can introduce himself a little bit.
Good. Happy New Year's, everybody. Thank you for your time. Purpose of today is to share our expertise in real estate, mortgage banking, and some limited, tax advice for real estate potential in terms of income gains as well as investment gains. Full disclosure, Raul and I are not licensed tax professionals. So this is a case-by-case scenario in terms of some of the information we do give you in that department. But the reality is there's no industry that has made the average Joe richer in terms of wealth, in terms of security, aside from real estate. So that's exactly what we're here to talk about. I'm a young gentleman. I was born, I guess, into this industry. My parents owned a mortgage bank, and in high school, my first job was processing loans, telemarketing mortgage leads. So despite my young age, I've got about 13 years in this industry, and I'm here to share every wealth of knowledge from being a portfolio manager, managing $13 billion in mortgages. I've ran multiple divisions down to what I love to do now, which is working with my real estate partners, working with consumers directly, and just sharing every wealth of knowledge that I have. There's not a single thing that brings me more joy than seeing kids light up, finding that they're going to get, basically keys to their first home. Just recently, we're coming out of the holiday season. So many families were so excited to have their first Christmas in their home. And again, there's nothing that brings me more joy than hearing kids run down a hallway, argue and fight about which room is theirs. And that's exactly why we do what we do, is to see the growth and opportunity for families, especially the first-time home buyers.
Yeah, and everybody in general. I mean, anybody who wants to jump into the market knows that they have some notion that that's a good thing for them.
Sure.
But they don't know until they're actually an owner,
right,
the potential of all the different things that can happen. And that's kind of what I want to talk about today, a little bit about everything. Actually, this space is for you guys. I'm going to basically be asking Chris all the things that I have been asked as a realtor. So this is how it works, right? People call me and they say, "Hey, I want to get a house," and I say, "Okay, great. Then let's figure out what you got going and what you need to get going to get there." And the people that help us is our lenders, our preferred partners. Our lenders basically make it all possible, right? Because I can just say, "Yeah, I'll get you the house," but how are you going to pay for it? If you have cash, cash is great, right? Everybody
cash is king.
Cash is king. But if not, you're going to need some type of mortgage. And so, going with that, let's if you can give us just the basics that everybody needs to remember, to have for sure, to work on, to be mortgage worthy.
Well, just to piggyback off what Raul said, the most important thing is to have a plan. And if you're like, I guess, 95% of Americans who don't have a couple $100,000 in their bank account ready to go, this is the starting block. You basically, you find a realtor that you want to work with, and sometimes this is incentivized by either you're coming to the end of the most common that we see is somebody's renting an apartment, they're coming at the end of the lease. Unfortunately, most people are reactive, not proactive. So we usually get the phone call, "Hey, in 30 days, I got to figure this out. Will you help me out?" Right? So, if you're in that situation, that's more than okay. Again, the biggest thing you should focus on is having a plan. Full disclosure, most people, it does take about 30 days to do the home shopping process. And then the lender typically needs about 30 days. Why? There's a huge, vast array of checks and balances that we do, whether it be verifying your employment, title work, appraisals, so on and so forth. And these things take time because there's seriously, specialists that do these types of tasks, and everyone, needs a few days to complete that aspect of work. But what we're looking for on the banking side is credit, your ability to repay us, and a little bit of cash to close. So we'll start off with the credit. And we're going to go pretty broad, guys, just because there's a lot of different people coming from different walks of life on here.
Yep.
First and foremost, credit. It's easier on the banking side to work with somebody who does not have credit than somebody who has blemishes on their credit. Now, if you're anything like me and you live life, you got a couple of scars, you've got a couple of bruises. So if your credit isn't perfect, that's more than okay. The good bankers have enough experience as well as the software and tools to give you limited credit repair. I want to be very clear, again, limited credit repair. These are little things like, hey, if you pay down your card balance, it looks like you'll capture a quick 15, 20 points. This could be something as simple as, hey, it looks like a good majority of what you have is medical collections. If you call this guy down the street, he's my credit repair guy, he'll get you cleaned up in 30 days. And, sure enough, the simulator shows us that you'll get 70 points. Myself, I do use a credit simulator. Basically, after I pull your credit, I pop you into the system. It tells me, hey, if you pay this balance down, you remove these collections, you will graduate to this design credit score. Now, most lenders, especially through the pandemic, are a little bit fearful where they're requiring generally about a 640 FICO score to do any type of financing, whether it's FHA, VA, conventional. I always position myself to work with pretty aggressive banks for the reason being that I like to be a one-stop shop. I am pleased to announce that my current bank is financing as low as a 580 FICO. This is strictly on FHA. This is strictly on VA. But the benefit is, as long as whatever speed bumps got you to a 580 FICO, we've kind of ironed it out, proved that that's behind us. We're generally good to go for financing. Now, this brings us to the next question of cash to close. I'm going to skip around a little bit and I'll explain why. Cash to close, right? That is going to be your down payment. That's going to be the closing cost. Down payment is basically your initial investment in the property. If you put yourself in the bank's position and shoes, to have somebody buy a house for, a small 1 to 3% on the dollar, in comparison to us bankers taking 97% of the risk, it's a little bit scary, especially if you're one of those people we talked about who's in the 580 FICO range. So, that down payment, it does go to your actual mortgage balance. It's not paying a vendor, whether it be like a title notary folk, an appraiser, points, nothing like that, right? It's actual investment that's going into your home property. So why is that important? Well, it's for pricing reasons. All these loans go to investors. The bigger the down payment, generally, the better the interest rate that you receive, the less risk for us banks. But if you don't have ample down payment, how do we get that? Well, if you're in a state that does offer some sort of a nonprofit or bond back down payment assistance program, that's where the next step is. And those programs, they're not controlled by us bankers. Again, they're backed by state entities, and they generally do have higher safeguards in place for this type of financing. I will give you an example. The most common one that we use here, AZIDA, Home Plus, that one requires a 640 FICO score. So again, having good credit is very important, especially if you don't have a lot of cash to operate. Unfortunately, the way that American industry, the way that our banking sectors are ran, if you don't have the cash, you better have the credit, right? Because that's kind of that score warrants whether or not you're worthy to receive these types of funds. If you're able to manage, and not only necessarily manage a loan, but also manage the forward trend of paying that back every single month. So you can get in the door with as low as a 580. Most people, especially first-time home buyers, need some sort of support. If you're not going to be getting a gift from a family member, you don't have an ample 401k, you don't have, basically substantial funds in some sort of a savings or checking account, the next best thing is that. But again, the 640 FICO score is what you need. Some of you folks are probably from California. That's a huge channel of traffic that we get for buyers here in Arizona. The bond programs in California do require a 660 FICO score. So every state's a little bit different. You'll want to talk to a local banker or reach out to us directly, and I'll point you exactly in the right direction or do my best within 2 to 3 minutes of doing some research online to let you know what your minimum requirements are in your state. But yeah, the next aspect of this. Go ahead.
Oh, sorry. Just, I wanted to rewind.
Sure.
That's all good. Great. So that simulator. I like the simulator idea because a lot of people have their own simulator in their mind, and they feel like they have it all learned. They learned everything, and then their friend told them that that's what they needed to do, but their friend's not a professional.
Sure.
And so I like the idea of the simulator to start early and start checking with with Chris and the professionals that know what they're doing ahead of time, 9, 6, even a year ahead, right?
Sure. Yeah. And just to piggyback off that as well, if you guys ever take a look at a credit report, you'll notice that they go in 30-day increments, 60-day, and 90-day. So let's digest that. Your bill is due once a month, right? So as an example, if I find something on your credit that needs to be fixed, and today is first week of January, the chances are that that advice that I gave you won't affect your credit for 30 to 60 days because credit only updates once a month. So to strengthen what Raul was saying, it's so important to have a plan and to do it sooner than later, because even though you met with a professional and you do what they tell you to do, some of these changes, they take time. And that's the most frustrating part about credit is you could fight to, tooth and claw today and things don't pop up for 45 days later. But, guys, if you have less than perfect credit, most people that do come in with that back of mind mindset are like, oh man, I don't know what I'm doing here. And then come to find out, hey, we're only 3 months away. I'm in a much better place. I'm so pumped. I'm so excited. Yes. And you know what, guys, the cost of living goes up year after year. To have a home, to plant your feet, to secure your housing for 30 years, because that's how long mortgages are month after month. That gives you peace of mind. That gives you the ability to grow as a family, to structure your finances accordingly. And then again, come with the benefits of that. But to pivot back to what we were saying, we talked about credit and what the minimum parameters are for financing. We talked about, next be the ability to pay or the cash to close. Cash, again, guys, that's going to be coming either from your checking, savings, a gift, or the state bond programs. Next step would be your ability to repay us. So what we're looking for is 2 years of strong job history. There are some caveats to this where you can have a break into your job history. Most of the loan agencies or investors that we use require that you don't have more than a 6-month gap of employment. Okay. Now, if you do, we've got to have a pretty darn good story as to why. There's very few investors that are okay with that length and break. I've had some families that, for instance, wife was a homemaker, had a strong history of 10 years in a career, had her first child, either had complications or said, hey, you know what, I'm going to give my first child a whole year off, right? That's something that's acceptable. Sometimes you see somebody who's in the military who received an injury, was honorably discharged. That's more than acceptable. Somebody who's challenged with life situations, either a sick spouse, dying spouse, themselves dealing with illness. So there's very few times that you can have that break. What we're looking for as well is proof of this income history. So this would either be W-2s. This could be also if you have a corporation because you're self-employed, tax returns. Maybe you already own investment homes, so Schedule E's, whatever it may be. But in order to use this income to qualify, it's got to be documented, and you've obviously got to prove it to pay taxes on it. So again, that's what we're looking for to prove your income. Sometimes people do receive a promotion and think, oh man, I just changed jobs, I'm not eligible to buy. No, that's not the case. The banks want people that are on the up and up. We want people that show stability in their income. So if you do get a job promotion, you do go to a lateral or competing company, and you do receive higher pay, that is something in our eyes that is good. Obviously, you'll need an offer letter to substantiate that. You'll want pay stubs. Even if you're getting a job transfer from one state to another, please talk to your banker, because there are some moving pieces to this. But again, as long as your employment and your documentation is supporting this lateral move, 9 times out of 10, we can get that income to stick.
Awesome. So piggybacking on the myths, so a lot of people say, okay, like that, what you said, I have a client right now that she had her baby. So she stopped working for a little bit.
Right.
And then she had another baby.
Okay.
And so but she's a super professional. She's been on in finances for a long time, and she just thinks that she won't be able to get a mortgage.
Yeah.
So that's one of the things. Another myth that I want to attack, right, is the big one, the big myth. Everybody has somebody that's feeding their mind with these. So they're saying, just wait. Right? Wait till the market crashes.
Right.
Where where are they getting this information from? Where are they getting this myth from?
You know what? Humans they're creatures of habit, and just goes back to, hey, a lot of us have scars and bruises, and guys, the reality is, if you were old enough to experience some of the negative impacts of the subprime meltdown back in 2008, 2009, if you got stung, you got stung. A lot of people lost 401ks. A lot of people had financing that was sour, whether it was a balloon payment that they owed at some point. Sometimes it was an adjustable mortgage they didn't realize. Again, I'm a product exactly of the mortgage banking industry. And, my parents, they went through their turmoils as well. I'll just leave it at that. But what I will say is I have a little bit of a broader scope than most people because I've done financing in as much as 26 states and manage mortgages all across the U.S. So I will tell you every market's a little bit different. Arizona is what's called the seller's market. They just point blank can't build houses fast enough to sustain the housing criteria that is needed. We have a lot of people moving here from California, huge waves, Colorado, Washington, Oregon, Texas, believe it or not, as well. And then you, of course, get pockets from, across the domestic U.S. as well. But, with that being said, this is a very unique sector where, again, if we can't substantiate the housing, that supply and demand is not balanced. And there's so many people buying here that I think right now we're at 244 people moving to Arizona a day, 244 families.
Yeah.
So we just, I don't think the builders can build fast enough to sustain that. So as long as we have that type of supply and demand environment, we're going to be in the safe harbor zone. In addition to that, with the rates still being very attractive, still being very affordable, money's cheap. And people know that, and they can afford to buy more house than they could this year than they could have 5 years ago when the rates were an average of 5.75. So it just really depends on your type of marketplace. Not to pick on anybody, but I've got family as well. They're moving out to Arkansas. Why? Well, you could buy a house there for, no joke, $75,000 on a quarter to a half acre lot. And how many people want to move to Arkansas where, industry is very small. The economy there is obviously a lot smaller. You'd have to work from home or do something online or do something that's unique, like being a corrections officer nearby, right? Versus you come to Phoenix, which is the 5th largest economy in the U.S. Hey, it doesn't matter if you're a doctor, you're a teacher, you're a cop. I mean, you're a photographer, you'll make it in this industry, right? So it does come down to unique economics to every single city sector that you're moving into. But my take, guys, depending on where you live, take a look around, do the research. Do you see houses in Zillow going up month after month? If that's the case, it's probably a seller's market. And the chances of you buying a house and then feeling like I got duped, the values went down. We honestly cannot promise you that on the legal standard, but law of averages tells us for the last 5 years, at least in Arizona, we're seeing appreciations as high as 25% in the last year. Year before that was maybe on average, I think like 20%. Yep. And that's value that you guys get to pocket in the form of equity. That's, again, another factor that has never built so much wealth for the average American family through real estate is by that appreciation in value.
So to bust that myth, to me,
okay.
What I've been watching and seeing is, so everybody just has that assumption, but nobody has any specific reasons. So going back 2008, everything happened, that big, huge recession, it was like a perfect cocktail. And and a lot of people in the industry actually kind of knew about it a little bit, here and there.
At some point, people saw the writing on the wall, but they just kept feeding into it.
Years ahead. Yeah. And so there is not one signal right now in Arizona that can cause an influx of inventory to make that balance go, opposite of where it's at. So demand is right here. Supply is
scarce.
Way down there. And so the only way that it can change is if supply, right?
If there's a cooling effect, yes. And the right now, if you guys are watching, I guess, politics in terms of inflation, interest rates, the way the Fed has always cured inflation is by hiking interest rates. Why? Well, people are less likely to go out and spend if they have to borrow money that's at a higher rate. And that is true also with real estate. So it just goes back to what we said. Do I think some demographics in some states will see a cooling effect? Absolutely. But where we live, it's starting to feel like a mini SoCal. Me, myself, I've got plenty of years vested living in San Francisco, Anaheim, Southern California. And the pricing is getting pretty darn close. Last year, I don't think I could get much. We couldn't get more than a 4-bedroom home for anything less than about $400,000. Thank goodness that FHA raised their loan amounts, so now we're able to give loans as high as $420,000 here in Maricopa County. But we're seeing that hike year after year, and we actually had this conversation a few days ago where 2 years ago we were helping families purchase houses, 3 or 4 bedroom houses, some of them even with swimming pools, like $330,000, $350,000, and these were top of the line quality homes, right? And this year we're looking at houses that are $330,000, $350,000, and we're seeing 3-bedroom, 2-bath, sometimes in rough neighborhoods. We're like, what happened to home?
No living rooms, no, they're beat down houses for $350,000.
Yeah,
and that's just, it's unfortunate, but we all have to adapt. And the only way to build your wealth is actually acquiring one of those, even if it's it's got a few. You
got to get your feet planted while you can before it's too late, right?
Even if you got to fix it up, or
Hey, they're selling houses in Compton and in Watts for as much as $1 million these days, believe it or not. And some of those people bought in for less than $100,000, 15, 20 years ago, right?
So I want to remind you that this show right now we don't have a lot of views or a lot of viewers that are calling in, and but we will have live calls if you call in. My phone number is right there. Give us a call if you got a situation if you're watching right now. Actually, I know that there's not many people watching, but if you're watching, if you got a situation you want to run by us, run by Chris, especially because he has the hardcore experience. I have the limited experience that I have, but I surround myself with huge people that can definitely help all my clients. So don't think that I'm doing any disservice, because I make sure that I get the top of the top. So, but anyways, where I was going with that is, give us a call. Give us a call when you're watching this show, or even after the show, or whatever. If you have a doubt, you have some type of myth or something that somebody told you, and you want to make sure that you run it by a professional, give us a call. Give Chris a call, or give myself a call. We're here. This is our passion. This is our,
It's what we do.
It's what we do.
24 hours a day.
So just remember, next show, or throughout the time here from now till next show,
right,
feel free and give us a call. The other myth. So along with that, that myth of
when's the bubble gonna pop?
Right? And all that. For those who it did pop before, and for those that have those scars that you talked about earlier.
Okay.
A lot of people think that.
Talking about foreclosure history, deed in lieu, short sales.
Yeah, if they lost their house some way, somehow in that recession, or even afterwards, they're not going to be able to buy anymore.
Right.
Is that?
It's case by case scenario. I will tell you that. Look, the reality is you got to live life, right? And you got to make a decision where it's like, hey, I took a risk, I bought a house, things didn't pan out. Maybe, again, you had health issues. Maybe it's just you got sour terms because they were doing pretty crazy and creative financing before 2008. But regardless of what it is, there comes a time when you got to dust yourself off and you got to reestablish yourself. Get that dust off, huh? You got to reestablish yourself for your family. And, there's two aspects of that. The reality is, guys, the cost of housing is going up year after year, whether you're renting and you're paying somebody else's mortgage, okay? Or you actually own your own property and you're paying yourself. But again, you gotta combat the inflation. You gotta combat the cost of rising rates and everything, whether it's gasoline prices, food, housing. So when you commit to having a 30-year mortgage, your pricing is locked in. Sometimes the taxes will go up. That's something that we can't control. If you have an insurance premium payout, let's just say you had roof damage, you accidentally had a fire, in your kitchen, something like that. That's something we can't control. But the principal interest is locked in. So imagine if you had yourself a 30-year fix that you committed to, even something as simple as 5 years ago, what that cost of living looks like versus today, it's probably 20 to 30% cheaper, right? And you have to remember, when you own a house, you get the benefits of the tax credits. I'll dive deeper into this, but again, we're not tax professionals. Everybody's case by case. If you have the capacity to itemize, meaning you could basically write off independent expenses. You can write off the interest on your mortgage. You receive a 1098 every single year. It's mailed to you by your servicer. You can write that off. If you're in a situation where you are self-employed, your tax professional will start doing things like renting a bedroom from yourself to operate your business. Whether or not you have a brick and mortar location makes no difference. They usually maximize your deductions. In addition to that, if you have multiple homes, you can have a Schedule E and write off every single aspect of tax bills, any type of maintenance. You can even start to do things like depreciate the value of your home. Now, there are certain factors that they have, but as an example, let's just say you have a home that's valued at $500,000 and you're depreciating something to the degree of $20,000 a year because you had to do repairs, or your specific marketplace maybe stayed flat or took a dip in value, right? These are things that your tax professional will do for you on a case-by-case scenario. That's why you have to consult with them. But just the very fact alone that, hey, if I'm going to spend as a renter, let's just say for simple numbers, $1,000 a month, that's $12,000 a year, right? I don't get that money back. I don't get to write it off. I'm just out $12,000. That's my cost of housing. If I have a mortgage, that's $12,000 a year, right? And of that, I'm spending $500 a month in interest, $6,000 a year. Well, at the end of the year, I can write that $6,000 off. Let's just say I had to do some upgrades to the home to maintain it. My AC got worked on. It was a windstorm. I had to get some shingles worked on. All that cost another $3,000. So I wrote that off in depreciation as well. There's a lot of things that you can do, guys, but if you talk to your preparer, that's just one aspect of the tax benefit. As you're using that vehicle, in addition to that, you have the values that are going up year after year, right? So let's just say, again, prime example, you bought 5 years ago for $300,000. That house today is probably worth close to $500,000. So that $200,000 that went up in value, you can either choose to leverage that equity in the form of a refinance cash out. You can do a home equity line of credit. If you're ready to upgrade, you can sell that house. Let's just say use $50,000 for the next purchase, pocket $150,000. What you do with that, you might make yourself debt free, so you're stress free. You might invest into a business, whatever it may be, right? But I hope you guys are seeing, as a renter, you pay that $12,000, you get nothing. As a homeowner, you get the benefits of tax shelter. You get the benefits of that equity gain. And in addition to that, your housing is secured. Your kids have a backyard. You've got your bedroom count. You know you can bank on this home month after month, year after year, and not have to deal with some, people sharing a wall, banging on it, throwing parties till 3 a.m, having to deal with landlords that are, stressful or barking at you because you're a day late on payment. And then last but not least, guys, you get all the protection of home ownership that comes with that. If you're ever in a pickle, you lose your job, your industry takes a hit, you can basically contact your servicers and work out some sort of a modification plan with them. Or if you are going to be late, you let them know. There are penalties that come with that. But again, your housing is secured one way or another, right? So I can't stress enough how important it is to own a home for those reasons. As far as you being duped and thinking, hey, I took a blemish and I don't deserve that, you got to knock that out of your mindset. Everybody needs a home for these reasons. As far as like penalties goes, guys, if you did have to go through a foreclosure process, it's generally a 7-year seasoning for conventional financing. Generally you're looking at about 4-year for FHA, VA type of financing. That's like the worst type of branding and blemish that you can get, right? Now, if you ended up doing a short sale, like you worked with the banks, you actually helped stage the home, you generally get a 4-year branding on that with conventional financing. There are a little bit of nuances, like when the actual home sold, they take a look at the title, things like that. But again, it's generally 4 years. And on the government side, you would be seeing about a 2-year span if you can do a manual underwrite. Not every bank offers to work with these types of blemishes, but if the bank you are working with does, you can generally skate by a little bit sooner. But it's case by case based off the seasoning, the totality of circumstances. If you work with the bank, if it was a bankruptcy. So talk to your mortgage or loan professional and we'll let you know.
Oh my goodness. All right. So there's a lot of possibilities out there, guys.
Yep.
There's a lot of possibilities. You just have to focus on your goal. Enter with some professionals that you trust. Hopefully it's me and Chris. Chris and I.
We get free advice.
Yeah, we get free advice. The other thing, so some people got into some bankruptcy.
Okay.
For example. What does that happen? What happens after bankruptcy for a person that wants to buy?
Sure. So the caveats to that is we see the again, the totality of circumstances in worst case. Unfortunately, most common forms of bankruptcy that I see are related to either divorce or health issues. If there is a mortgage that is involved, the banks say, okay, well, this person has a bankruptcy. They also included a mortgage. Which one is the worst hit that we're going to take? Well, if it was a full foreclosure, they hit you for the higher one, which is that 7-year seasoning. If you just truly had a bankruptcy, you did not include the mortgage or did not own a mortgage at the time, then we're going to go based off of the branding of Chapter 7 or Chapter 11. That's the most common. Chapter 13 is generally for corporate debt. But one of them is basically you had all your debt forgiven, and one of them is you worked with the courts and you went on a payment plan that was approved and you went there. If you do take the payment plan approval route, you will need permission of the courts to enter if you're still working with them. If you've satisfied the terms of your bankruptcy, then at that point, we are waiting for a 2-year seasoning on FHA, and it would be 4-year with conventional. So again, it's not really far of a stretch, guys. You would want to reestablish your credit and basically show that you're in a much better place. The way you do this is by opening up new secured credit cards, by having strong payment history. You write a letter of explanation just saying, hey, look, my wife went through cancer, the medical bills piled up. That's why we had to file bankruptcy. If you take a look at my credit, I've absolved myself of all those medical collections. I'm here to tell you that my wife's in their place, she's healthy, we're both back to work, and that's why we're looking to purchase a home. So at any point, you just want to prove that you're past the hump and you're in a better place.
So you said 2 years?
On FHA, yes.
On FHA?
VA, government financing.
And then?
It would be 4 years. It would be 4 years on the conventional side.
I'm just checking to see if any of you have any questions. Let's see, anybody in the chat? Well, not yet. But next show, you got to get in here and got to give us those situations so we can know. Worst
case scenario, you leave us a delayed comment and we get back to you as well.
Yeah, that too. Feel free to, comment on here and we'll get back to you. And then, so moving on to...
What you got next?
So I would like to basically, like I told you guys, a little bit about everything. It's a little bit about everything. And if someone's renting, for example,
okay.
If they're renting and they are, trying to get ready to buy, and the landlord says, I might sell it to you if you'd like.
Sure.
Is that a special situation? Is that something that's in their benefit? Can they?
So the answer to that is yes and no. Guidelines have different types of requirements. So FHA, as an example, stands for Federal Housing Administration. That money is backed from a government agency. And because of that, they have a little bit of a stronger stipulation on who they will lend to and what they will lend on. So as an example, let's just say you're renting a home and your landlord is going to sell you the house. FHA says, hey, you need to at least lend a home to prove stability and that you like the house. Not just you were hard on housing, some guy let you rent, and then the next month selling you, a house that's about to fall apart, but you're desperate, so you're going to it, right? So that's not something that FHA would be acceptable with. Conventional loans, they don't really care, to be frank with you, because they're privatized by banks. Like a bunch of banks pull their cash together and the money circulates through Fannie Mae and Freddie Mac. So their guidelines are a lot looser in that department. You could definitely work out terms with them, right? Let's just say you've been renting from a family member for 5 years and you guys obviously love each other. You've got a fair and respectful understanding, not only on business, but on the family value side. And maybe they're willing to say, hey, you know what, we'll cut you a break and we'll sell it to you for exactly the value of the house. We're not looking to make a huge profit. And in addition to that, just to show you we love you, we'll even throw $5,000 towards your closing costs, right? So yeah, absolutely. If they're willing to donate equity for the down payment or closing costs, that's something you can do. A lot of times we have family members that are, reaching an age where, hey, I'm 70 years old. I've got this 5-bedroom house. It's way too much for me. Son, I'd like to give it to you, but I do need a little bit of cash on the way out. I don't know where to start. You contact your realtor. They'll help you and get you set up on something like that. And again, usually in situations like that, nobody's looking to make a heavy profit, just enough where everyone feels good. And, you can do things like I've seriously helped families purchase houses with a couple $100, like $700, where they're just paying for the appraisal. We design it where the person who's selling the house, the family member, is gifting them the down payment, gifting them the seller concession to cover the closing costs. And that's the most beautiful setup for anybody, right? It's a win-win. We're not stressed on cash. The banks know exactly where the money's coming from. It's the existing value. And you just simply sign a letter, from seller to buyer. This is my son. This is my cousin, whatever it is. I'm giving him this with no intent of repayment. I love you. Enjoy the home, right?
Yeah.
So that's the most ideal setup, guys, is when we see family to family exchange. But it's very doable. And it all, again, comes back to, where do I start? Well, you got to contact a professional to get you going.
And so from there, if the landlord's not going to sell it to you, and you're not related, and you're not that lucky to get
Sure, like most people,
you want to jump out of that rental. He already spoke about a lot of those points that you need to start getting prepared ahead of time.
Right.
And so you always want to. There's possibilities out there that you might find a rent to own, but those are kind of, in the seller's market, very slim pickings there.
You got to be careful too, because generally those terms and conditions are thick, where if you miss one payment on time, all that money that you gave them ends up being absorbed by the landlord, and that rent to own is no longer rent to own, right?
So it's kind of tricky. You got to call us and we'll figure it out for you and help you out throughout the situation. The next one is, I have a bunch of equity in my house. So that's one of my defenses for a lot of people who say, oh, there's going to be a bunch of foreclosures. A lot of people that purchased after 2008, they've purchased at a really low price,
right?
And they've been able to either almost pay their house off or pay their house off,
or double it in value,
Right. And so, like, all that equity is going to protect that influence of inventory, I feel.
Sure.
I feel, because there's all kinds of situations you can do, especially, like, let's say it's not, it's not because you want to lose it, you want to upgrade. It's not because you're gonna lose it or anything like that. You're just gonna upgrade
your quality of life.
You can use all the equity to many different points, right?
Sure.
Many different.
Yep, that's something that we commonly see. Prime example: somebody has more income and they maybe want to live in a better zip code for their kids to go to better school. Sometimes you see families are having another child and they just outgrew their circumstances. Mom's getting sick, they're moving them in, whatever it is, right? But you hit it right on the hammer. So I guess first step is, hey, what are we going to do with this existing property, right? At that point, 9 times out of 10, you're going to rent it. You can either contact your realtor and see if they have a rental service that they offer. If not, there's huge conglomerates out there like renterswarehouse.com. To my understanding, they charge $100 a month. So they're very financially friendly, and they take care of everything from finding the actual tenants to doing the screening to doing the exiting process. And if they don't perform on payments, they do that nasty aspect of starting to knock on doors and make the phone calls. But once you do find a tenant, you'll want to find out what that rent schedule is that you can receive. Because if you are going to pull cash out of the home, the goal is to have that tenant not only pay for the mortgage, but also call it what it is. It's an investment. You want to create some income and margin for yourself. The margin is important, yes, because we do want the income, but also you need to protect yourself because houses do need maintenance. So whether or not it's, again, roof repair because of a heavy rain and storm season, could be something as simple as cleaning the AC ducts once a year, and you're going to need a little bit of margin to protect yourself with that. So as an example, if somebody ends up having a home that's got a value of $500,000 and it's got a mortgage balance of $200,000, they pull $100,000 out. Now their new mortgage payment is, for simple numbers, $1,400 a month. Okay, they contact Renters Warehouse. Turns out they can rent the house for $2,200. Renters Warehouse is.
They contact the grandmother group, and if they want to, we'll figure it out for you there.
There you go. We contact the Grimaldo group, and turns out that they're going to be able to rent it for $2,200. But don't forget, Grimaldo's got a $100 step-on fee every month to manage this for you. So now your margin in that equation is $700 a month. All right, that's pretty good. Now we got $4,800 a year, right? Wow. Year after year, you can bank on that. And remember, guys, the cost of living goes up. So if you feel, based off the fact that the marketplace is going up, hey, this is a 1-year locked-in term. Next year, we're going to revisit this conversation. You could do that, right? So in that same conversation, you've got somebody who's paying your mortgage. You got all that cash out. You've got $100,000. What do I do with it, right? Well, I'm going to go out and buy a new house. That tenant is paying a good portion of your new mortgage because that's your profit, plus the value of your existing home is still going up. So the equity is gaining, right? And in addition to that, you've got your tax write-off. That's exactly the type of I guess, elements of home ownership that we're trying to convey to you. In that example, that person has the tax benefits, they've got the equity that's growing, somebody else is paying it, it's not coming out of your pocket anymore. Plus, you walked away with $100,000 and you're upgrading your quality of life. That is a win-win, no-brainer. That's, I would say, probably about 30% of the business that we do is families that are doing that type of setup. And then with that $100,000, you basically design a mortgage payment that's comfortable, knowing, hey, whether or not you choose to use some of that money from the rentals up to you. But that's it, guys. That's the secret. It's a simple rinse, wash, repeat. We've got clients, average Joes that own as much as 8 houses. You shake their hand, you would never know that they're investors, but this is a small secret, and some people choose to participate into it. But that's, I guess, come the time of retirement, if you do own even just 4 houses and they're valued at $500,000 each, you got $2 million you're sitting on for a rainy day if you don't have 401ks, or maybe you don't have Fortune 500 label jobs that are offering you robust pensions, retirements. That's it. You got to have a game plan. We all get old and need to rest our head, and for me, that's definitely going to be one of my I guess long-term goals for retirement.
Now, there's people also, Chris, that won't want to rent their home out, and they just want to purchase another home.
Sure.
And they have a bunch of equity in there, and they want to see what they could do with getting that second home.
So the banks are going to allow you to purchase a home regardless of whether or not you have a tenant. Your income does have to be strong enough to support both properties. The way that you can offset that, depending on the investor that you work with and the bank's policies, I have investors in particular that I basically will say, hey, get us the paperwork for the person who's going to rent the house. Sometimes they have to make a deposit, sometimes they don't, depending on the investor. And from there, the bank will say, okay, we'll wash that mortgage payment. We know that they're not going to do it. It is a little bit of a unique situation that person doesn't want to rent it.
Wait. Sorry, I missed the detail.
Sure.
They don't want to rent it per se, but they don't want it to be their. They want to rent the second home.
Okay.
They want to live there, use the equity, rent the second home.
Gotcha. So they're buying an investment property with the. Okay.
Yes.
Gotcha.
Yes.
So different loans, different mortgages have different requirements. So as an example, if you've got good credit, Fannie Mae, Freddie Mac, they have a first-time home buyer program that will let you purchase with as little as 3% down. If you're a subsequent buyer, meaning this is not your first time, it's your second home at any capacity, you generally have to do 5% down. Okay. Now that's a primary home, meaning you're planning on living into that home for the majority of your time. A second home is a home that you plan to dwell for 60 or more days out of the year. And it generally has to be 50 miles away from your existing home. I do want to disclose that the government, FHA, VA, they are not involved in financing anything other than your primary. So if you were to qualify for this, you would have to have a 620 score for the conventional side. You would have to have the ample down payment, which is 10% on a second home. And, most of the time these homes are cabins. They're Airbnb type of properties that are, maybe by the beach. They're generally homes, again, that you are not going to dwell in for the majority of your time. And then last but not least, you have an investment home. Those are homes that you're truly not going to dwell in. And if you are, it's at a very limited capacity. Airbnbs, big vacation home styles where it's very clear that you're not going to use it commonly, right? As an example, let's just say like we live in Arizona and I buy a house in Miami in a condo. Well, what's bringing me back and forth, right? The banks are smart. They're going to say, hey, listen, man, you work at, as an example, Walmart locally. How is it you're going to travel back and forth, right? This smells like it's an investment home, not even a second home. So you just have to be very clear that you stage your intent, that you've got backing evidence. And if you truly are, like as an example, a trucker, I've got a gentleman who's wanting me to help him finance a home in Florida, and he actually does have routes in Florida, then we can substantiate and prove that. And the bank says, okay, this makes sense, right? He does get income from both sides of the hemispheres of the U.S. We'll back you on that purchase.
Awesome. All right. Last but not least, guys, before we leave,
okay,
there's some people out there that say, you know what, the home prices are skyrocketed. I can do, a lot of work. I have buddies that are contractors. How about we buy a piece of land? I got some money laying around. I want to buy a piece of land.
Sure.
And I want to construct on there. Or I just want to buy a piece of land and have it because I don't want to spend my money.
Sure.
There's those situations with land involved.
Gotcha. So just to be clear, so I digest this, you're talking about a family that wants to custom build a home.
Either custom build,
okay,
or just buy a piece of land, as an investment and, watch it develop around there, and then when the time's right, they'll.
So every single loan agency or investor does offer some sort of like a limited construction type of loan. FHA has their 203K programs. Those generally are not tear down and build up. Those are, you found a house that needs some substantial work, but again, it's an existing house. And there are some bylaws, like you can't do anything that's luxury. You can't change the fencing. You can't do TVs, but you can get appliances. So that's them, right? On the conventional side, you have the home style renovation loans. It's the same type of scope where it's not built for luxury. It's for actually repairing homes that have existing dwellings. If you are wanting to just purchase land, that is not what mortgages are for. You would need to get a land loan. And generally, in my experience, credit unions are the best for that. They've got excellent terms, as well as offer usually what's called a one-time close. Okay, so again, that's on a land loan. If you are wanting to custom build a home, you're going to need to break it up into sectors. You'll need a loan for the materials. You'll need a loan for the actual land. And then you'll need a loan for the actual contractor. Okay, they generally don't just give you one giant bag of cash. The banks are smart. Unfortunately, there is predatory contractors out there that will, falsify or use your funds, and then sometimes they don't show up to work afterwards. So they generally do what's called draws. So you'll have a couple of draws. Okay, but the cool thing here is the credit unions, depending on where you go, they'll offer you a two-time close where they give you the money for the construction process. Then they refinance all that debt into the mortgage, or they'll offer you a one-time close. You will be working with somebody who is experienced from the bank. It's usually a consultant. Every time they step foot on the property, they're not only billing you, but they're doing their due diligence to make sure that the permits are validated, that the materials are using are going to add up to the value of the home that you're suggesting. So it's not a bad process to go, guys, but it is a very expensive process if you don't know what you're doing. I'll give you an example. Just to connect utility lines here in Maricopa County, Arizona, the water is about 45 grand to connect the piping from your central key system where the water connects to your home to the street. And in the eyes of the city and utility companies, this is a luxury project you're doing. We are responsible for the actual utility line itself. But if you want any connection points, you got to pay that. It's the same thing with electricity. The other caveat to that is if you're living out in the boonies, you can have a septic well tank, generators running on propane. And again, those are generally tanks underneath. You could dig your own wells. Even wells these days, guys, because of water shortages, specifically with farming, it's a little bit of an unrelated topic, but it's a dig wells, whether it's farming application or for housing. And even those people are 3 to 6 months out in terms of, like a waiting list, and they charge as much as like 120 grand to do that. So you got to be prepared because these applications to build a house are costly. There are delays in financing that occur, whether it be weather or material shortages. And those are things that cost you time on financing, right? Because all of this is finance. So you'll just want to make sure that you do have a contractor that is reputable. Word of mouth is probably best, and as well as have somebody who is experienced and shows you, hey, here's my portfolio projects. Here's what I expect. And the bank will support you as long as you have a robust plan put together.
Awesome. Wow. Okay. So, to conclude, everybody, please watch out for the next show. Please feel free to contact us from here till then to be able to answer any questions that might have arose from all these memory joggers that he gave us. I mean, it was a lot of information, but that's what experience does, guys.
That's what you got, whether it's questions on manufactured homes, credit, maybe you want to build a custom home here, you're thinking about renting a house. Maybe you guys are just stressed with debt and you're looking for the next best way to get out of the situation. Whatever it is, if you are interested in purchasing a home or own a home and are looking to improve your overall financial situation, your housing situation, please use this as a resource. That's exactly what we're here for, guys.
All right. Well, thank you very much, guys.
Thank you for having me, brother.
Thank you, Chris. See you guys on the next one.
Peace.